This is Shirin Purewal. I hope you're all doing well on this Friday of January 2021. All right, so what's today's topic? It's a topic that for most people is what it all comes down to, and actually for everyone. When you're buying real estate, it all comes down to money. So the number one thing that I always encourage anyone who's looking to buy a home is, have you been pre-approved for financing? That is the most important point, first and foremost. So on that topic, what are the steps? Some ask me about credit scores. So luckily I used to be a mortgage broker before I went into real estate, because for that same reason, you got to understand the whole process. And the first step being the financing process. What are the key points that you need to know? Yes, credit score does play a part. Down payment plays a big part. Some have asked me, can I buy a house without down payment? Ooh, those days are long gone. No, you can't. It used to be that you could just even self-declare, say I made 100,000 and no down payment, buy a place. 50, 10 plus, I would say, 10 plus years ago, maybe longer than that, 13 years ago, you could do that, buy a place without down payment. But the good old days where that was the case are gone. Well, I mean, it's not good or bad. It's just there's more measures put in place now to protect the economy and people who take advantage of that. So the minimum so you can put less than 20, this whole 20% down payment thing. You can put less than 20% down payment when you buy. And what happens is the CMHC or Genworth, these companies come in and tell the person who's lending you the money, whatever bank or mortgage placement, company it is, well, they'll say, okay, you give Jenny a mortgage for, I don't know, 200,000, and I'll insure it. Okay, it's insured, and she can put less than 20% down payment. Now, if she puts 10%, there's a fee. If she puts 5%, there's more of a fee, because the less down payment you put, the higher risk you are. So what happens as a result of you putting less down payment and higher risk, the premium goes up. Okay, so if I want to put 5%, let's say it's a higher premium, but you won't see that premium because it's just lumped into your mortgage. So let's say the premium is 20,000. It's going to be, instead of your mortgage being 200,000, it's going to be 220,000. So it's put into the mortgage and it's part of your monthly fee. So, I mean, lots of first-time home buyers do that. There's a whole first-time home buyer program. Now, in order to get this insurance on the mortgage and qualify for it, these companies have said the person has to have good credit score. There's all these requirements. The down payment can't be, I don't know, in some cases gifted, so your parents can't give you the down payment. It has to be your own down payment. There are ways of working with the down payment. You speak to your mortgage broker and they can advise you on that. But typically, with most people who have cash in an account or money being given to them, or I don't know, money being brought from overseas, there are some rules, and I respect the rules, because rules are there, put in place to protect us, and the economy. So the rule is that money should be typically sitting in a bank account for 3 months at least. So I had one client call me a month ago, and she's like, yeah, Shireen, I want to buy, I'm selling my house in this country, and the money's coming, and let's go ahead. And I said, whoa. Before, I know you've got this home worth a lot of money in this country, and, you're excited, let's go home buy. But, first of all, are you pre-approved in this country? Yes, that may be a great amount of cash that we could do. But I always say, until the banks here say you're good, or until that money can sit, because they also know the banking rules better. So when that money comes in, how long does it have to sit in a bank account? All those details, what documentation's needed. There's documentation needed now when you are bringing money in from overseas. So they can advise you best on that front. But typically, if it's coming from overseas, it's got to sit in a bank account here for 3 months. And I believe if it doesn't, don't quote me on this, you need to have proof of that you've sold your home, and then the paperwork gets a lot more. So if you want less paperwork, let the money come here, sit in 3 months, no questions asked. That money's been sitting in the account for 3 months. That's my money. Bank goes ahead and considers that as your down payment proof. So the bank needs all these proofs from you. That's why I say pre-approval is so important, because come we go see a home and you love that home and I put an offer in on that home for you, you only have 2 weeks to get all of this together. And that's not enough a lot of times, especially in a seller's market. So I said, before we even get into the game of, or it's not a game, but before we even get into the whole, let's buy a place for you and find you a really good property, we have to make sure we're prepared. And that all comes down to money, which is financing and getting pre-approval. Now, a really important point I want to make is that pre-approval doesn't always mean approval. So you may be pre-approved and your mortgage broker will be like, yeah, based on what I'm seeing, right? Based on what you're telling me right now, yeah, you're good to get a mortgage. Now, let's say you get pre-approved and we go look at homes and the scenario changes. Let's say you forgot to tell your mortgage broker about like some looming debt, or you forgot to tell your mortgage broker, or in the between that you went and got a car loan. So many factors can change, and you go back and we go for approval and the bank's like, yeah, you got a pre-approval, but the approval, I can't give it to you. Or it could be that, and banks, because they lend you money against the collateral, which is the house, send an appraiser, and the appraiser is like, there's not enough income from the suite for me to give you this approval. That's the ultimate thing that it all comes down to for buying a home. So number one step, definitely pre-approval. My number one recommendation is don't even start looking at homes until you're pre-approved, because your time is precious, first of all, and you need to know what your budget is. I've had doctors tell me, oh yeah, I could buy a house for over 2 million, husband and wife, both doctors, and it turned out they, like, because of the situation or the change in their outcome incorporated, that wasn't actually the actual fact, right? So ask the bank what it is that you can get, or the mortgage broker. Number one, once they give you that budget and you have an idea of your pre-approval, let's go start looking at homes. Once you find the home that you like, then the next step kicks in of, all right, this is the home I want. I put an offer in with the condition of me getting approval. And then the bank says, all right, I'm going to give you an approval, but I'm going to need an appraisal done on the home. I need to see some documents from you. Okay, so then they're going to see, give me your latest pay stub, or your latest notice of assessment, or a tax information or whatnot. And every bank is different, right? And every bank's going to ask you for something else. That's why the mortgage brokers shop around and say, oh, this bank, you don't have this, let's take you to this bank. Or it may be sometimes that you have to go to private lenders, right? That you say, none of the banks want to touch your lending. That's where the mortgage broker comes in handy. And I work with this awesome guy who I refer a lot of my clients to. If you want, I could definitely help you out with his information. And he will, regardless of what your scenario is, put you in the path that you need to be. All right. So, and there are some banks that have amazing programs that none of the other banks can touch for certain niches. Every bank has its niche. So I would say having someone who knows all those niches will work to your advantage. And, some of you say, oh, I saw an ad in the paper, HSBC saying, but, this amazing 5-year, and I'm going to tell you guys a little tip here. 5-year fix for 1.2, 1.5%. So banks make their money on penalties when people try to get out of these fixed mortgages. And the reason why, notice how the 5-year fixed is always sometimes cheaper than the 3 or the 4 or whatnot, because they want to incentivize people to fix in at the 5-year rate, because the average Canadian refinances after 3 years, needs money out of their equity after 3 years. So they're like, boom, I gotcha. I'm making money off you trying to get money out of your. So yes, unless you're 100% sure you don't need to touch that property, you don't need to sell that property, you don't need to do anything with the equity in that property, it's just you're leaving it there. Then I used to always recommend, back in the day when I was a mortgage broker, and for my own personal mortgages too, 5-year fixed. It's a no-brainer. But if you're going to need that money for any reason, or you think you may want to flip that property, or you want to do something with it, then I would always say go variable. And the reason being I would say go variable is because with a variable product, whether it's a 5-year variable, 3-year variable, it's 3 months interest penalty only to get out. All right. And if at any point you're worried interest rates are going to go up, you can fix in. So it's like, what? This is win-win, right? I can fix in when I'm worried, if I'm worried of it going up. And if I do need to get out, I can pay 3 months interest payment. So if your interest payment on your mortgage, the interest portion of it, because there's a principal and an interest portion, if the interest portion of it is $1,000, 3 months is 3,000. But had you been fixed in with that same payment, the penalty to get out would have been 15-20. So you see the difference there? So personally, I recommend going variable all the time. And if you've got cash lumen, or you know your money's coming in, you could pay it off in 6 months, I would just say go open, because at that point you just pay it all off without any penalty. No, why lose even the 3 months interest penalty? You have to do the calculation though, and that's something you and your mortgage broker can calculate what the best scenario is. And I always say this: no one can make a better decision for you than you. Everyone else can give you advice, can give you the facts, but you take those facts, you digest it, and then you come up with the best decision for you. So again, consult your mortgage broker. They'll give you all the points, the different scenarios. What I can do is just give you some advice, and you take it from there. So what do I want to say? Okay, so back to the mortgage thing. So I typically do variable on all my mortgages, and with the current what we're seeing in the economy in Canada, where the banks will not be taking mortgage rates up anytime soon, I would say variable, variable, variable all the way. Okay. And it's never worried me. Like one lady told me, oh, a year ago I fixed in because they thought there's whole rates will go up. Just the way our economy is heading, and what I'm seeing right now is interest rates are not going up anytime soon. Okay, because what the whole economy is based on right now is debt. And oh my goodness, just pausing right there. The whole economy is based on debt. They can't afford to increase those interest rates. It's going to be kept low, and there's going to be a program of increase probably over the next 5 to 10 years. That may be a plan, or maybe 3 years plus. No, again, no one has a crystal ball. But in the short term, for sure, interest rates are not increasing. Go variable. If you're worried of it going up, you could fix it at any time. Again, personal view on that front. And the nice thing is, if you want to touch your equity, you need money out of your property, it's gone up in value, you can pull that out as well, being variable. And different banks have another program where as you pay down your mortgage, you have collateral on the other end that you can pull out without any penalty, even if it's fixed. So again, speak with your mortgage broker. They'll give you the different scenarios. So we talked about pre-approval. We talked about approval. I talked about what my favorite mortgage product is: variable, 3-year or 5-year, because they both have the same rule. I'll double check that, but if I recall, it's just 3 months interest to get out. What else do I want to share with you guys regarding financing? Those are the key points. So, and the other thing I love about the mortgage guy that I use is if you give him permission, just like your accountant, he can access your Revenue Canada account, and he can pull up all your tax. Because I remember looking for my NOA, or just even just dealing with taxes. I don't want to go there. Don't send me to go look for these documents. So you just give them access. They go grab the documents they need. They come back to you and they just ask you the questions. Let's make the process easy. And that's what I love. Even when I'm working on real estate, we're not going to complicate things. Let's keep it easy, straightforward. And hence why, before we even go look at homes, pre-approval, that's one thing out of the way. Once we're looking at home, we know exactly what our budget is. We know exactly what the bank wants from us. We ask for those things. We make a move. We get you your approval. And then once you get the approval and you check the home out and you love everything about it, we go to what's called your closing date. So between that and the closing date, you have to make sure that the down payment's in the bank account. Some banks require you to get insurance. Before you go to the lawyer's office, make sure you get your insurance in place. These are all things your mortgage broker will tell you to be aware of before closing. And then you go to closing and they ask you for a bank draft to say, okay, where's that down payment you told us about? You show up with the bank draft, you give it to the lawyer. The lawyer does all, and you beforehand also remember when we got approved and we said we want to go through with it, you give a deposit, okay, to the realtor, the buyer's realtor. So if I'm acting for you as the buyer, you give me a deposit. You never pay the deposit in the personal name. The deposit goes to the brokerage. So you give me the check and say, Shireen, here's my deposit. I want to go through with this house. I take that deposit and put it in trust with my brokerage. They put in a trust account and hold that deposit right up to closing. Closing, you're showing up with your bank draft. The deposit is counted towards that money as well. The lawyer does an adjustment, and boom, I meet you a few days after you go to the lawyer's office, and I hand you the keys to your new home. And it's an exciting chapter. It's a wonderful chapter, and I love helping people. Honestly,